So the labour market is just not strong enough to worry about it?
I think the labour market still could use additional support from monetary policy, and that's why I dissented last meeting, as I have continued to dissent for all previous meetings.
How lonely were you at that committee meeting just last week, voting for a 25 basis point reduction in the face of an energy shock? How robust was the conversation around the table?
Look, I think a lot of people around the table, like me, were hesitant to draw conclusions from the oil news thus far because, as I said before, we have to look 12 to 18 months out, not what happened to the oil price yesterday, right? And so looking 12 to 18 months out, there's still not enough clarity to think that monetary policy itself should adjust in response to what's happened.
Well, check out the oil futures curve. That has changed. I've just had one eye on December over the last 3 weeks or so.
Yeah.
That's gone from the 60s and threatening to break out into the 90s at one point earlier on this morning. That's a change. That's a real step up, no?
It has, and I boosted my, in the summary of economic projections, I boosted my inflation dot for the end of the year to 2.7%, reflecting that in part, right? So there is some expectation of higher headline inflation. However, as I said before, I think it's way too early to draw conclusions that it's bleeding beyond headline inflation in a way that matters for monetary policy. Don't forget, higher oil prices also depress demand, right? They take money out of the pockets of consumers that we're spending on other goods and services and redirects it towards gas and other energy costs, and that depresses demand and causes unemployment to move a little bit higher. That offsets some of the increase in inflation.
One of your colleagues this morning, Austin Goolsbee at the Chicago Fed, speaking to the press, saying we could see a circumstance where we'd need to raise interest rates. How high is the bar to raise interest rates? What kind of circumstances would you personally need to see?
Yeah, so I just laid out a couple of them before, right? If it looks like the oil shock is bleeding into inflation expectations beyond the first year, then you get really concerned about second-round effects. Or it looks like you're starting to cause a wage price spiral. Then you get really concerned about second-round effects. First-round effects are not something you traditionally respond to as a central bank. Now, I'll say one thing beyond that, which is that these oil shocks have been things that the Fed has looked through for a long time, right? It would be highly unusual for the Fed to start looking through them now. And when you think about what happened in 2021 and 2022, we did have negative supply shocks, like the oil shock from the Russia-Ukraine invasion. But in my view, part of the reason why it was able to reverberate through the economy the way it did was because policy settings at the time were very different. Monetary policy and fiscal policy were at all-time historical accommodative levels. We were doing $120 billion a month of QE. We were doing $2 trillion fiscal packages at a time. That's not the case right now. We're not hitting the gas on demand that would interact with the higher oil price in a way that would reverberate these prices through the economy now. That's not the case at all.